every Monday to Friday. This is Peter Lewis's Money Talk.
Money Talk.
Good morning, this is Peter Lewis at the start of a brand new month, Tuesday the 1st of August. Welcome to Money Talk and thank you for supporting this podcast over the past 4 months. We're now regularly among the top 20 most listened to financial podcasts in Hong Kong. This podcast is sponsored by Surfing Group, which is headquartered in Singapore and offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, activity in China's manufacturing sector has fallen for the 4th straight month. China's official manufacturing PMI rose to 49.3 in July from 49 in June, beating market estimates. Growth in China's services sector has hit a 7-month low. The official MBS non-manufacturing PMI for China declined to 51.5 in July from 53.2 a month earlier. And while pointing to the 7th consecutive month of increase in services activity, the latest result was the softest pace in the sequence. And the softening pushed the composite PMI down to 51.1 in July from 52.3 in the previous month. That's the lowest figure since December 2022. Hong Kong's economic growth slowed sharply in Q2. Hong Kong's economy expanded 1.5% year on year in the second quarter, far lower than market forecasts of 3.6% growth and easing from an upwardly revised 2.9% advance in the previous period. The slowdown in GDP was driven by a smaller increase in household spending and a decline in government spending and fixed investments. Growth in the Eurozone economy beat expectations in Q2 and inflation slowed in July. The Eurozone economy grew by 1/3% in the second quarter after a flat first quarter, and that exceeded economists' forecasts for a 0.2% expansion. The annual inflation rate in the Eurozone slowed for a third consecutive month to 5.3% in July from 5.5% in June. That was in line with market forecasts and it was the lowest reading since January 2022. The core inflation rate, which excludes prices for energy, food, alcohol and tobacco, was unchanged at 5.5%. On today's Money Talk, we're joined by Asian fund management industry consultant Stewart Aldcroft, Michelle Lam, Greater China Economist at Societe Generale, Corporate and Investment Banking, and our US economics correspondent, writer and broadcaster Barry Wood. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com, and also take a look at my daily newsletter.
Peter Lewis's Money Talk.
US stocks marked the 5th consecutive month of gains in July and the longest such run since the summer of 2021. The S&P 500 edged up 0.2% to close at 4,589 for the month of July. The benchmark index rose 3.1%. The Dow added 100 points, or 1/3%, to settle at 33,560, taking its monthly gain to 3.3%. And the Nasdaq Composite rose 0.2% to end at 14,346. It registered its 5th straight winning month for the first time since April 2021. The US dollar index rose 0.2% on Monday, but was still down 1% last month. That's its 2nd straight monthly decline, as US inflation shows further signs of cooling. The most pronounced selling activity was in the Japanese yen after the Bank of Japan expanded the band within which the Japanese 10-year government bond yield can fluctuate, but it did signal it wasn't the start of a campaign of tightening monetary policy. And the BOJ stepped in on Monday, buying bonds in an unscheduled announcement to stem the rise in yields. On Monday, the dollar rose 0.8% to 142.24 Japanese yen, and for the month, the yen has weakened by 1.4%. China's renminbi saw its best monthly performance against the dollar in 6 months. In onshore markets, the yuan closed 0.1% higher Monday at 7.1425 renminbi versus the dollar, and that takes its gains for the month to 1.5%. After the People's Bank of China deployed some direct and indirect support measures to fend off downward pressure on the currency. Mainland stocks rose for the 2nd straight session as investors reacted to the latest Chinese economic figures. The Shanghai Composite climbed 0.5% to 3,291 after rising above 3,300 earlier in the session. And for the month of July, the index is up 2.8%, taking its gains for 2023 so far to 6.5%. Hong Kong stocks rallied for a third day. The Hang Seng Index climbed 162 points, or 0.8%, to 20,079. The index rebounded 6.1% in July, but it's up just 1.5% for 2023 so far, making it one of the world's worst performing equity markets this year. The tech index surged 1.9% Monday, adding to a rally of 4.4% last week, which has put the index in a new bull market after it rebounded more than 20% from its recent low in May. And this morning, futures markets are pointing to gains of 80 points. That's 0.4% for the Hang Seng at the open. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
We have a panel of guests scattered far and wide over the world this morning. Stewart, Aldcroft, Asian Fund Management Industry Consultant, definitely here in Hong Kong. I can see him myself. Morning, Stewart.
Good morning to you, Peter. Yes, definitely here, looking outside at the bright sunny weather that we've been missing for a while.
Yeah, lovely. And also with us here, also here in Hong Kong, Michelle Lam, who's Greater China Economist at Societe Generale Corporate and Investment Banking. Morning, Michelle.
Hey, good morning, Peter.
And over in West Virginia this morning, I can see him sitting in his log cabin right now with the fire raging in the background. Barry Wood, our US economics correspondent and writer and broadcaster. Morning, Barry.
Good morning, Peter.
And let's start with China's manufacturing activity. China's official manufacturing PMI rose to 49.3 in July from 49 in June, and that beat market estimates of 49.2. It's the fourth straight month of contraction in factory activity, but it is the smallest decline in that period. New orders, buying activity all fell, but at a slower pace, and export sales continued to drop. Employment decreased for the fifth straight month, with the pace of job losses accelerating, but business sentiment improved to a 4-month high. The official MBS non-manufacturing PMI for China, that declined to 51.5 in July from 53.2 a month earlier, while pointing to the 7th consecutive month of increase in services activity, but it was the softest pace in the sequence. Michelle, can you take us through these numbers for us? The two highlights seem to be the slowdown now in the services side and manufacturing still in contraction. What are your thoughts?
Yes, so first of all, on the services PMI, that was disappointing because we would have thought that the reopening recovery could continue to support the service sector momentum. But clearly, even though we've seen that from the news that it seems that the traveling seems to pick up even more in July, it's not enough to really lift the overall service sector. And I think for the non-manufacturing, a big component for the slowdown is that for the property sector, we continue to see the sales tanking, and that's definitely has affected the construction the activity as well, which is the part of the component in the non-manufacturing PMI. So I think tackling the property sector weakness is really the primary task for the government in order to stabilize the growth momentum. And on the manufacturing side, I think it seems that maybe we've seen the worst of the manufacturing contraction. It's not doing great, but I think that in the second half of the year, we probably see a little bit of a stabilization in the manufacturing momentum. But the external environment is still not looking well. We don't really expect the global growth momentum to be much stronger from here. So I think that's still going to be a drag on the exports, and that will still be affecting industrial activity. And also for the domestic demand, if you look at the consumer demand, the investment demand, I think it is still very important for the government to boost the confidence of consumers and the private investments. But right now, I think it remains to be seen that whether all these stimulus measures that the government has rolled out over the last two months will really work to reverse the situation.
Are you worried that the services sector could slip into contraction now as well?
Not so much for the service sector. I think the reopening recovery should still be continued, but probably at a slower pace in the second half of the year compared to what we've seen in the first half of the year. But what I'm worried is the property sector. as we know, like, the property sector is very important for the China's economy. It's 1/3 of the overall economy, including the indirect linkages. But based on what we see in the high frequency data, it seems that the sales hasn't really managed to stabilize. If this situation continues, then I think that's going to be imposing further pressure on the property funding, and that will also in turn feed into the property investments, which has, by the way, already deteriorated quite a lot since the peak in late 2021. So I think this is something that we should definitely watch out for.
I would be concerned about the economy, because China is obviously trying to do lots of different things to maintain or boost the economy in many different areas. And it seems to me that we are now at a point where a lot of what they're trying to do isn't working, or isn't working as well as they want to expect. And we've had, 20 odd years of economic growth in China, and our expectations are probably far higher than the market is going to be able to deliver. So I think we're going to need to start to think of lowering expectations for the Chinese economy for the next few years.
All this talk, do you remember, it wasn't that long ago, there was a lot of talk, wasn't there, that by 2030 China's economy would overtake the US's economy. That's really not going to happen based on what we're seeing at the moment, is it?
Not really, but I think that you've got to remember the scale of the Chinese market is massive still, and ultimately it is about the scale that will be the booster, but it's still not going gangbusters as it used to, as we should say. I think that there are slowdowns, there are inevitable blockages, and Michelle's reference the property sector to be worried about. I think we're desperately worried about the property sector. Every time we see any of the major property companies in China talk about their business, it's bad news. And the level of debt that is being racked up in the property sector is enormous. That will take a lot of resource to sort out, and I'm not 100% convinced that China is in a position where it can actually do that.
Barry, this is getting the attention of the US, isn't it? Because Janet Yellen has mentioned now recently a couple of times the slowdown in China and the potential effects that could have on the US economy and the global economy.
Well, that's true. And I think that any slowdown is manageable if it is within the realm of 3 to 5% GDP growth for the year. As to this question of when China is going to surpass the United States in GDP, they need a 6 to 9% annual growth rate to really boost per capita GDP figures. Certainly it's going to happen, but it's not going to happen as fast as had been predicted, as you observed. The slowdown in China, I think, may go some distance to explain why, after Secretary of State Blinken's visit, there has been a steady stream of American visitors. Clearly, the American market as an export market is very important to the Chinese, and I don't think they want to do anything that jeopardizes that short term.
Mm. Is this starting to look like Japan in the 1990s? Do you see any sort of similarities between what's happening in the slowdown in China and what happened in Japan, where ultimately it slipped into deflation, didn't it? The economy stagnated for years because the old playbook of relying on exports, boosting infrastructure expenditure, just ran out of steam. It just didn't work anymore.
I don't really think so. I think, we've a lot of countries, a lot of economies learnt what not to do with what happened for Japan over the last 30 years. So I don't think that's going to be the way of this, but I do think that the political and economic leaders in China are not necessarily talking off the same page at the moment. And I think this is also going to be something of an issue. One other aspect, which I think is also quite important for the circumstances right now, is that the government is trying to support the renminbi quite significantly. The strength of the renminbi has only returned in the last month or so, coinciding with these many international visits that they've had. They can't afford for it to fall too much further against the US or other currencies. And bear in mind that this marginal recovery, as it is, has occurred at a time when the US dollar has itself been a little bit weak. So, there's a fair bit to be looked at in terms of the renminbi. If it falls very much further, then of course we get back to a point where China's exports will start to be looking quite cheap.
And that would of course be good for growth, wouldn't it?
That will be good for growth, but it won't be well received by the US.
I think that one of the lessons that I've heard from China analysts who are speaking at international gatherings over the years is this, that the mistake that the Japanese made to get into that 30-year deflation was that they allowed the currency to skyrocket as the Americans had wanted in, 1985. Certainly the Chinese are aware of that and determined not to make the same mistake. Their currency indeed is on the weaker end of the band. And I think also inflation is low, and that's a warning sign for the Chinese, because that, of course, is the Japanese malaise. But I agree with you, Stewart. I think they're a long way off. I wonder if Michelle sees it the same way.
So I do agree with you, Barry, that I think the Chinese policymakers a lot of Chinese economists and academics, they studied Japan's deflation experience very well. And they definitely do not want to repeat the mistakes that Japanese policymakers made 30 years ago to put Japan into the last decade. But I think currently the situation of China is actually a bit different from Japan, in the sense that if you talk about the property bubble, of course, right now China is definitely struggling to stabilize the property sector. But I would say that it's not likely to have a sudden and sharp bursting of the housing bubble, because actually, if you even look at the house prices in China, it's managed by the policymakers. And if you talk about there is like in the worst case scenario that maybe people no longer are buying houses, I think the policymakers will be very quick to ease up the policies, as they already signaled in the Politburo meeting that they will be easing up the restriction measures, probably even in the top tier cities. They will be cutting mortgage interest rates. And I think worst come to worst, they can even use the government resources to buy up some of the properties and use them to convert them to rental properties. So I think these are the measures that probably the Japanese policymakers did not really have the resources to do it a long time ago. They haven't even thought about that. So I think it's for the property sector, it's probably a matter of time that we can see that it will manage to stabilize. But it's just I think there's still some maybe the political hurdle struggle at the policy level that they did not want to inflate another bubble. They worry that they may just make the speculative demand come back. So I think there's a struggle there, but the situation I think is getting worse, and probably the policymakers will definitely ease up a lot more measures to stabilize the sector. And back to the question on the deflation example, and well, in Japan we also a long time ago there's also the corporate debt crisis that resulted into the many bad loans in the banking system, and the government has not really been quick to tackle the problem. But for China, if you look at what happened in the 2000s, they actually they are quick to recapitalize the state-owned banks by issuing the special central government bonds, and like with the reserve required ratio cuts, I remember back then, and also to recapitalize the big four banks. So the financial system is actually very very controlled in China, and I'm not really worried about the kind of like the debt triggering a banking crisis that would cause the banks to tighten the credit conditions, and the banks will just stop lending to the private sector. The kind of like that crisis, I don't think that's going to happen in China. But I mean, like right now, China, I think there's some similarities or like the risk of deflation that I'm worried about right now is that definitely the households, the private sector, the confidence, the sentiment is definitely not strong, and I think that is the kind of there's just a loss of animal spirit that I think maybe we are in a situation that even if we have more monetary easing, and that may still not be able to revive the confidence quickly, and that's going to take time. That's number one. And second is the kind of in the past we've always seen the when the growth slows down, then the government stimulate with infrastructure stimulus, and now that has resulted in a large amount of local government implicit debt, and there are now rising concerns about whether these local government financing vehicles can really repay the bad debts. And it seems that the government still seems to prefer the approach of like kicking the can down the road, ask the banks to extend their loans to these zombie local government financing vehicles. And I think that is just making the capital misallocation problem worse. And I think over the long run, that's going to definitely drag down the productivity or the long-term structural growth for China. And in that case, I think that's a kind of like debt deflation situation that China will run to. And that means that we're going to see lower long-term structural growth for China. That's still going to like bring with problems of disinflation or even deflation.
That's the big challenge, isn't it, Stewart? China's got to at all costs avoid slipping into deflation.
Yeah, but I have to say, Michelle, I think if China does go down the route of having, in effect, government buying up property to support the property sector, that's going to send out really negative signals to the rest of the world. I think many people will want to run away from that pretty quickly. It's not the route forward. It's not the way forward. There needs to be a few major bankruptcies, and that would probably, major bankruptcies would probably bring more support rather than less, frankly, from an international investor perspective, because that's what they're expecting.
Yeah, they've actually done that in 2016, but basically using government subsidies handed out to people and allow them to move from the old houses and move into new houses. This is a way of government trying to provide support so that they can digest the empty houses more quickly. So they've done that, but just in low-tier cities. So I think it's something that on the table and it's the last resort, but it's not. Maybe I think over the coming months, this kind of measures are not going to be announced, I hope. It's a kind of worst case scenario measure that they could think about.
Yeah.
Let's turn our attention to Hong Kong, because economic growth here has slowed sharply in the second quarter. The economy expanded 1.5% year on year. That was far lower than what economists were expecting, 3.6% growth. It's eased from an upwardly revised 2.9% advance in the first quarter. The slowdown was driven by a smaller increase in household spending and a decline in government spending and fixed investments. A surge in services trade was offset by a sharp decrease in the import and export of goods. On a seasonally adjusted quarterly basis, the economy contracted 1.3%. Economists have been expecting it to expand by 1%. Stuart, what's going wrong? We've really for about 3 years now, isn't it? Apart from a couple of little spikes, the economy has just been in the doldrums here.
Yes, obviously one of the things, this volatility in the numbers is what happens when you're seeing changes and adjustments in the post-COVID environment. Clearly, we're still adjusting to having gone through an extended period of no visitors to now having people starting to come back. As from the beginning of this year, we've had about 15, 18 million visitors now for the year so far. But Hong Kong is no longer the manufacturing centre that it used to be, and it's no longer the place from which many Chinese exports are then re-exported, and we're not sending things into China as much as we used to either. So I think these are the areas that, it's particularly in the sort of import and export of manufactured items, that's going to continue to reduce. On the services side, yes, that is a strong area for the Hong Kong economy, and I would expect that to start to grow as it has adjusted for the return to a more normal economic position after COVID.
Michelle, what's your assessment of Hong Kong?
So I think staying in Hong Kong, I can actually sense that if like on weekends, actually there are not many Hong Kong people staying in the city, but a lot of people are just traveling abroad with this. After COVID, everyone just want to go traveling. But at the same time, when the mainland China tourists come to visit Hong Kong, I think like some of I spoke to some friends, and actually they don't really stay overnight. So I think that's more of a problem towards the tourism exports and tourism imports. So on the one hand, we have tourism imports that are expanding very strongly, but for tourism exports, actually, my sense is that maybe the improvement is not very remarkable, considering that there are also news reports saying that maybe Hong Kong is no longer the travelers, the shoppers' paradise, given that people's spending the mode has changed. Actually, there are also many
They're going to Shenzhen, aren't they, instead?
In the mainland China.
Yeah, they're going to Shenzhen.
There's actually no strong reason for them to come to Hong Kong to go shopping for the luxury items, I think, which is one of the most popular reasons. So I think that's going to be one thing, how to increase the attractiveness of Hong Kong as a tourism spot. And second is also that the private investment, if you look at the data, there's also a small contraction. So I think that's really to do with, on a cyclical basis, how long the interest rates are going to stay high for here, because as long as it's going to stay high, it's going to affect the investor sentiment to make the investments. And second is the structural angle, that is how much the investment sentiment is affected by the external factors such as the US-China tensions, and whether Hong Kong can really position itself as an attractive place to invest versus places like Singapore in the long run.
Okay. Barry, let's turn our attention to the US. Get your thoughts on the inflation data. I mean, the gauge of US inflation that Fed prefers is now at a 20-month low. The Personal Consumption Expenditures Price Index rose 3% in June, down from 3.8% in May, and the core PCE index eased more than expected to a 20-month low of 4.1%. There's getting a really strong feeling now, isn't there, that the trend in inflation in the US is downwards, and the Fed is getting on top of this.
Absolutely. And I think the fact that they rose again last week, and that was accepted and applauded by the market, is really a sign that the Federal Reserve is winning the battle. There's no doubt about that. They're not going to declare victory because that's not in their playbook. But it seems to me that analysts will increasingly be saying, both on inflation and avoiding recession, certainly on job creation, the Fed has done a masterful job over the last 14 to 16 months. So yes, I agree with your assertion. All of these inflation measures are very positive. It's a real victory, not just for the Fed, but also for the Biden administration.
Is
this what's driving the stock market up then, Barry?
What's that?
Is this what is driving the stock market in the US up?
Yes, I think
the support is there.
Yeah. Look, valuations are, of course, too rich. So that can't explain why the tech sector would be rising at such a phenomenal rate since the first of the year. So there's something else going on here. And I think it is that the United States is going to avoid recession. That's my guess, Stewart.
It's odd,
or has avoided recession and that it's unlikely over the next 3 months.
It's odd, isn't it, what the Fed has achieved here, because despite inflation coming down, the labour market is still very tight. What normally happens is that unemployment goes up, reduces the demand for goods and services, workers get laid off. That normally leads to the recession and inflation comes down. But the US has managed to get inflation down without that decline in employment that you would normally expect to see.
You're absolutely right. This is unique. And it's unique particularly because interest rates have risen so much. Obviously, if you're buying a home now, you're paying almost double what you would have paid 18 months ago. And that is a burden. And yet there's a lot of money from the COVID stimulus that's still in the economy. So it is unique. And maybe that's a word of caution, because if that money is at some point going to run out, then maybe we'll once again be looking at at a recession risk. But so far, given the wins on inflation, the wins on job creation, it looks to me like we're absorbing these interest rate rises much better than have been anticipated.
Is there also one big factor here? It seems that companies are not laying off workers. They're very keen to try and hang on to their workers, unlike in 2020 when they were very quick to lay off people, and also after the last recession in 2007, 2009, workers got laid off very quickly. It seems that companies will do everything to try and cut costs, use technology more, but hang on to their workers. That's also...
Yeah, that's true. With the notable exception of the tech sector, because if you look at what has happened in the Silicon Valley and certainly in San Francisco, there have been 30 to 50,000 layoffs since the beginning of the year. But that's been absorbed with almost no pain at all experienced by the company, certainly in the terms of their valuation. And you don't see any kind of unemployment problem that has emerged in the Bay Area. So, yeah, I think you're right. I think that it's not typical. Now, we've just had a bankruptcy of Yellow Roadway Freight. That's at least 30,000 people directly will be out of work. There's, of course, a residual effect because there are many more people affected. We'll see if that has any impact. We avoided the strike from UPS. That's been good news. So, I hate to sound Pollyannish, but really it looks quite good here in the States.
Okay. And Michelle, in just 30 seconds, presumably if interest rates have peaked in the United States, that's good for us here as well.
Yeah, that's good for us. But I think there's some points I want to highlight is that if you look at the profit margins of the U.S., actually, it is still at the historical, much higher than historical average, which means that actually some companies, big companies, they've actually locked in the low interest rate cost during the COVID period. And right now, even interest rates have risen, that hasn't really hit them hard. And I think that's one explanation that why the corporates could afford to hold on to not firing people as much, given that the economy is actually doing okay, and with this low financing cost that they have fixed in some time ago. So I think that's a reason to highlight. And yeah, for Hong Kong, I mean, if interest rates are not going to rise further, doesn't mean that we are out of the woods yet, but at least maybe the worst is over for Asia here.
Okay, well, that's good news. Thank you very much. That's Michelle Lam, Greater China economist at Societe Generale Corporate and Investment Banking. You also heard our US economics correspondent, writer and broadcaster Barry Wood. He's over in the US. And our Asian fund management industry consultant, regular Tuesday commentator, Stewart Aldcroft. Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. On tomorrow's programme, I'm joined by Enzio Von File, Capital Preservation Specialist at Financial Shield, and Christopher Lee, Partner at Farron Augustine and Alexander Investments. And later in the show, I'll chat with Dickie Wong, Head of Research at Kingston Securities. See you tomorrow.
Money Talk